What if I told you that while the broader markets were getting absolutely obliterated, a single AI small cap was quietly coiling into one of the most explosive technical setups? And what if I told you that the window to act on it is measured in days, not weeks, not months, but days? Welcome back to Smart Stock Sam, the channel where we cut through the noise and bring you institutional-grade analysis on the setups that actually matter. I'm talking about Rezolve AI, ticker RZLV. And right now, right at this very moment, it is sitting at the epicenter of what we're calling the double squeeze. Is Rezolve AI finally ready to break out after this consolidation? What are the real price targets heading into next week? That is exactly what we're unpacking today. And trust me, by the time we finish walking through the technicals, the fundamentals, and the options mechanics, you are going to understand why the smart money has already placed its bets. So if you have ever wondered what it looks like when institutional giants quietly build a floor underneath a stock before retail even knows what's happening, stay locked in, because this is that moment. Let's start with what we call the coiled spring thesis. Picture a spring being compressed under the weight of a chaotic macro environment. Every point of market pressure doesn't destroy the energy, it stores it. That is exactly what has been happening with RZLV. While broader sentiment has been unstable, this stock has demonstrated proven relative strength. And that strength isn't built on hype or hope. It's built on four very specific pillars. Pillar 1, macro resilience, meaning this stock has held up when it had every reason not to. Pillar 2, aggressive fundamental expansion through a series of European acquisitions that are reshaping the company's revenue ceiling. Pillar 3, a structural price floor being constructed by institutional players owning 28% of the float. And Pillar 4, the imminent catalyst, the double squeeze setup converging between March 16th and March 20th. The spring is fully compressed. The question now is, what happens when it releases? And if you want evidence of that resilience, look no further than what happened during one of the most turbulent macro stretches we've seen in recent memory. In just 2 trading sessions, we watched the Dow drop 1,500 points. The S&P 500 posted its worst week since October. The VIX Fear Index spiked above 30%, a level that historically triggers panic selling across every high-growth, high-beta name in the market. Oil surged past $100 a barrel. In that environment, a small-cap AI stock should have been completely eviscerated. Instead, RZLV trended up 6.88% on March 10th. It hit its primary technical target of $2.87, while virtually every other growth stock was bleeding out. Now ask yourself, who has the conviction to buy aggressively into a macro shock like that? The answer is never retail. The answer is always institutional capital absorbing every share that panicking traders throw at the market. Now to be fair, and this is what separates real analysis from hype, the move wasn't perfect. RZLV printed an intraday high of $2.93 and confirmed the $2.87 target in the after-hours session, which happens to align almost exactly with its 50-day moving average. But we did see a deviation from the secondary targets of $3.15 to $3.40. Why didn't it go higher? External macro ceiling pressure. That VIX spike triggered a flight to safe haven assets, the dollar, treasuries, gold, and temporarily suppressed high-growth AI names across the board. But here is what matters. The internal engine of this company did not stall. The macro applied the ceiling, but the company's fundamentals are still building upward pressure from underneath. So what is fueling that internal engine? Let's talk about what Rezolve AI is actually building, because this is where the fundamental story gets genuinely exciting. The company is executing a $230 million cash acquisition of Reward Loyalty UK. This isn't a speculative bet or a pivot announcement. This is a completed transaction that officially finalizes the company's AI technology stack, creating an integrated, end-to-end enterprise solution. Think about what it means for a company to go from building individual components to owning a fully assembled proprietary stack. The competitive moat widens dramatically, the pricing power increases, the customer switching costs go up. All of that compounds into higher quality, more predictable revenue over time. Simultaneously, they are expanding into the European ride-sharing sector through FreeNow, targeting a market that has been massively underserved by AI-native commerce technology. Think about what that means for revenue visibility. Rezolve isn't just building software for one vertical, they are assembling a global ecosystem. And global ecosystems, when they reach critical mass, tend to get valued very differently by Wall Street. The question worth asking is this: how many other small-cap AI names do you know that are simultaneously closing a 9-figure acquisition and expanding into a new continental market at the same time? That combination of execution is rare, and the market hasn't fully priced it in yet. And Wall Street is absolutely starting to notice. Let's talk about price targets, because the gap between where this stock is trading and where analysts believe it should be is almost hard to believe. Even the conservative end of the target range sits at $4.14. That is a 54% upside from current levels. The consensus average sits at $11. That is a 300% move from current prices. And if you look at the aggressive target from Maxim Group, they are looking at $15 a share. Compare that to the current price of approximately $2.69, and you have one of the most significant asymmetric upside opportunities in the entire technology sector right now. But here is the thing about price targets. They are just numbers on a spreadsheet unless someone is actually defending the stock at these levels. So let's talk about who is doing the defending. Institutional ownership has reached 28% of the float, and this isn't a collection of small speculative funds. The California State Teachers Retirement System, CalSTRS, one of the largest pension funds on the entire planet, recently boosted its stake by 72.3%. Vanguard and Ameritas have been steadily increasing their positions throughout late 2025 and into early 2026. These are not traders looking for a 10% pop. These are long-duration capital allocators building a base. When pension funds of this scale increase their exposure by 72%, they are making a statement about long-term conviction. That statement is the foundation of the institutional floor we've been discussing. But there is one entry above all others that serves as the keystone of this entire bull case. On March 6th of 2026, as the broader market was beginning its most aggressive sell-off in months, HSBC Holdings established a brand new position in RZLV. Let me put that in context. HSBC entered this stock during a macro shock, at the exact moment when most investors were running for the exits. By doing so, they effectively declared that the current price level represents fundamental value worth defending. That single action acts as a structural floor, reinforcing the support built by CalSTRS, Vanguard, and Ameritas, and creating a safety net directly beneath the technical setup we're about to break down. Now, let's look at what the market itself was communicating on March 12th and 13th, because this is where the squeeze story really starts to take shape. The stock pulled back approximately 3% on March 12th. But here is what that pullback was actually telling us. Volume came in at only 12.8 million shares, against a daily average of 25 million. That is less than half of normal volume on a down day. In squeeze mechanics, that is the signature of seller exhaustion. Long-term holders are refusing to sell. Weak hands have already been shaken out. The daily RSI is sitting at a neutral 44.11, not overbought, not oversold, just a stock sitting on a coiled spring waiting for the trigger. And the price is holding a significant premium above its 52-week low of $1.07. The sellers are done. The question is, what happens when the buyers show up in force? Here is the tactical setup you need to know heading into the week of March 16th through 20th. The ideal entry zone sits between $2.65 and $2.70, directly on the 200-day moving average, which is a textbook technical buy signal. Hard support is established at $2.50. The first resistance hurdle is the 50-day simple moving average at $2.75. Clearing that level opens the door to the breakout target at $2.87. Now, what happens if the stock clears $2.75? That's where this gets explosive. Part 1 of the double squeeze, the trapped shorts. Short interest currently sits at 18.95% of the float. That represents nearly 37 million shares that must eventually be bought back. The days to cover is 3.71, meaning it would take nearly 4 full days of average trading volume for short sellers to fully exit their positions. As this stock stubbornly refuses to break below the institutional floor, those short sellers are not just losing money, they are bleeding borrowing premiums on every single day they stay in the trade. They are trapped, and the longer this floor holds, the more desperate their eventual exit becomes. Part 2 of the double squeeze, the put wall floor. On the March 20th options chain, there is a massive concentration of open interest at the $2.50 put strike, over 33,760 contracts. In simple terms, the market makers who sold those puts are financially motivated to keep the stock above $2.50. They will hedge, they will buy, they will do whatever it takes to defend that level. This synthetic floor stacks directly on top of the institutional floor, creating a two-layered defense that shorts are running directly into. And once the stock clears $2.75, it enters what options traders call the gamma void, a zone of almost zero overhead resistance in the options chain. At the same time, the $3 strike is acting as a powerful magnet with over 31,000 contracts of call open interest. As the price approaches $3, market makers are forced into a Delta-Hedging rally. They must buy shares on the open market to balance their books. That buying accelerates the price, which triggers more Delta-Hedging, which triggers more buying. It becomes a self-reinforcing loop that is very difficult to stop once it starts. Short sellers covering plus market makers Delta-Hedging plus institutional buyers defending. That is the double squeeze, and it all converges inside a single trading week. Looking further out, our forward outlook is a strong buy. The earnings date on April 22nd is the next major fundamental catalyst, and we expect confirmation of substantial revenue growth from both the Reward Loyalty and FreeNow integrations. That confirmation is what bridges the gap between current technical momentum and the aggressive Wall Street targets of $13 to $15 per share. Could there be turbulence between here and there? Absolutely. Markets never move in straight lines, and macro shocks can compress timelines. But the structural setup underneath this stock, institutional ownership, the put wall, the gamma void, the exhausted shorts, creates a risk-reward profile that is genuinely difficult to find anywhere else in the small-cap AI space right now. The spring is fully loaded, and every day it stays compressed. More energy is being stored for the eventual release. Before we close out, a quick but important note. Everything discussed in this video is for informational and educational purposes only. Nothing here constitutes financial advice, and nothing should be interpreted as a recommendation to buy, sell, or hold any security. Always conduct your own due diligence and consult with a qualified financial advisor before making any investment decisions. Markets involve risk, including the risk of total loss of principal. Now here is the question I want you to sit with. Given that institutional giants like HSBC and CalSTRS entered or expanded their positions during a macro shock, and given the double squeeze mechanics converging this week, does the risk-reward on RZLV justify a position, or does the macro uncertainty make you want to wait for more confirmation? Drop your honest answer in the comments below. I read every single one, and this is exactly the kind of debate that sharpens everyone's thinking. If this breakdown brought you value, hit that like button. It genuinely helps push this content in front of investors who need to see it. Subscribe to Smart Stock Sam if you want institutional-grade setups delivered before the move happens, not after. Help this video climb the hype leaderboard on YouTube, and let's get this analysis in front of every serious retail investor out there. The spring is coiled. Now you know exactly what to watch for.